You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. What a week. All right. Specifically, what a week for the energy sector. We had the oil futures contract, which expired on Tuesday of this week, go negative. So for the first time ever, we saw a situation where if you wanted to get rid of your oil via the futures contract, you had to pay somebody to take that oil. Now, there was a lot of underlying issues that happened with it. And in particular, it was the WTI contract, which is the West Texas contract, which is a landlocked contract. So the reason why this happened is there was so much supply in the marketplace and there was nowhere to put that supply. So people had to, in theory, pay for people to actually take their oil, or they had to think about stopping production, and it costs a lot to shut down a wellhead, everything that's involved with it. Not to mention, you might not be able to start it back up after you shut it down. There's just a lot of things and a lot of costs that were involved with it. So for a time being, we had a situation where that futures contract went negative, and it went quite a bit negative. Well, interesting. Guess what we talked about on last week's show? We talked in particular about the USO, which is the ETP that tracks the near-term futures contracts. Now, nothing was meant to be a recommendation, but what we were talking about in general is that we just saw a potential for a more volatile marketplace as opposed to a less volatile marketplace. And the fact that I think last week the USO was trading at about 430. We looked at buying the 450 put with the May 15th expiration and the 415 call. And we said that this, so far this year, and even a little bit at the end of last year, there's been more volatility in the marketplace than less volatility in the marketplace. And a lot of times we talk about people just kind of have a misnomer that we should always be selling options, that is the only way to make money trading options. And if you expect more volatility, you can always look at doing a long straddle, and on Options Playbook Radio, we've really hyped long straddles on companies like Boeing, the USO. We've talked about it in a few times, and a couple of other underlyings. You can go back and look at previous versions of Options Playbook Radio and see some of the other underlyings that we were talking about. But in general, the implied volatility marketplace had came down. It was down. The VIX index was down below 50. The USO had high implied volatility, but it just wasn't crazy high implied volatility considering just basically where oil was at in the marketplace. So that trade, we put it on for around $1.25. The USO closed today, and I should let you know that we are taping Options Playbook Radio on Wednesday, April 22nd. The markets are closed, and the underlying USO traded on the close today at $2.50. So in theory, if I was doing this trade, you would have probably gotten out of it based off of all the news overall, but you might have rolled into a spread, because that is what I was talking about when I was doing that's what I was talking about when we were on the show last week, is if the market does go down a bit, implied volatility should rise, and maybe you might want to roll into a spread. And you could either sell the 250 strike, you could sell the 3 strike. There are many different strikes that you can choose from within that expiration that you might want to consider doing. And then that allows you to remain long, and we are going all the way out to the May 15th expiration. We also looked at MRO. We talked a little bit about that underlying, and one of the things was we were just going to look at both of them. Now, MRO did not move even close to what the USO, considering there's no way we would have known that that was going to happen this week. But the MRO traded at today, it closed at $4.50. It's up 29 cents on the day, and we were looking at the 4 strike call option and the 4 strike put option. So obviously this didn't do as well compared to the USO. But now you're talking about one underlying. They were the same price. We're looking at paying approximately the same price for both of them. And you're talking about a company like Marathon Oil versus an ETP, a product that's based off of the futures. So if I'm paying the same type of volatility on both of those, you got to think, well, gosh, if I'm going to buy a long straddle, why wouldn't I want to be in something like that tracks futures prices as opposed to a company, an actual company's stock prices overall? So that's what we did. That trade kind of worked out. And I think if we're going to look into the USO, now the implied volatilities have skyrocketed across the board. If we look at that same May 15th expiration, we see the implied volatility of the 250 strike, the most at-the-money strike, that's trading at 180 at this point in time. And that now it feels like the implied volatilities are kind of back where they should be, considering what was going on in the marketplace, or a little bit more relative pricing area. So if I was thinking about doing the USO, I would be looking at laying down until the urge went away. I don't think I want to pay these type of volatility premiums based off of where that underlying is at right now and everything that has came into the marketplace. So what would I want to do in oil? Well, there's been a lot of talk about the ETPs, particularly the USO and the USL. And there are some of the nuances in the USO that we have to be aware of. And those really came to light this week in particular, considering that every major news outlet was trying to figure out the whole gamut that was happening in the oil world and the pricing of oil, the spot price, the futures price, the back month option, the futures price, everything that was involved with it. So there is an inherent risk to a lot of these ETPs, and we saw this last year in the volatility indexes, and that same type of risk is applying now and being brought to light again in some of the oil products. And one of the risks, for lack of a better term, is the roll risk. when you have these products that are investing in futures, it takes a lot to manage those products. And based off of the terms and conditions of the ETP, the exchange traded product, there are time periods when they have to roll their option contracts. So in this day and age where oil is at, the front month being, and sometimes a lot lower than the further out months in option contracts, you will, if you consider that trend always stays, then you're usually selling options in the near term that are priced lower than the ones that you are buying. And based off of that, whenever that roll happens, it may be an inopportune time to do that, but they have to do it. Specifically in the USO, which is the shorter term oil contract, that has to happen, and that happens more often than in the USL, which is the United States long-term oil contract. But both of those products have this risk that is not really highlighted in the fees as part of the prospectus for the ETP. So in some ways, it can help out. I mean, it's not always an absolutely bad situation. Sometimes if you're rolling and the roll happens in an opportune time, right, it can be a benefit. You might get a spike up in the near term and be buying the long term. So there's no good or bad, but it just so happens that in this week, this was in general a bad thing for those underlyings. And we see that. And the fact that today the price of oil in the futures contract in general went up, but the ETP, the USO, still went down. And we've had that happen. That was down 30 cents today. Right now, that was about 10% of that underlying price. And you're going to have scenarios where you might think the price of oil is going up, but you look at a fund like the USO and you see the price is going down. And that happened with a lot of these type of products with the volatility situations that we've been having recently with a lot of those things. So in general, you got to be made aware of that. So why do I go through this long little story? I'm not making any recommendations on anything here on Options Playbook Radio. We always just are trying to learn. And I think if you are going to try to invest in these are becoming some of the more popular products to trade in. If you're going to invest in these type of products, you need to understand some of the risks that aren't spelled out in the prospectus of those products. So if you were bullish on oil, what are some of the things that you might want to look at? Well, maybe you might invest in some of the oil companies. And this was brought up a lot this week also, in that even though oil was going all over the place, the price of oil, the spot price of oil, the futures contracts, no matter what expiration you were looking at for those contracts, the prices of oil was jumping all over the place. But a lot of the oil companies in general weren't moving as much relative to the price of the actual a barrel of oil. So that's because it's a little bit more looking at the longer term outlook for those companies. Yes, in the short term, they're going to hurt. There's going to be a situation, but they're a physical company. And so you just don't, it's just like investing in a tech stock, any other stock out there. They have assets, they have earnings, they have dividends, or some of them don't have dividends, but there's a foundation for that underlying stock and where it's at. Now, they might go up and down as oil goes up and down, but in general, a lot of these companies will do that. And there are exchange-traded funds, most of them are funds as opposed to products, that will just invest in companies that are in the actual oil exploration business, the transporting business, everything else that oil generates jobs for and revenues for overall. Now, just one last thing before I let you go here, we'll give you one trade for the week, one paper trade to watch, is because of the supply and demand thing, a lot of things that actually went up relative is the storage facilities. So in particular, a lot of the tanker companies that are in the business of transferring oil and storing oil. Now, those companies all had a real good week because that is what created the issue in oil overall. All right. So let's go in and look at, we talked about MRO as a long straddle candidate before. Let's just take a company that we might consider looking at, like let's talk about ExxonMobil. ExxonMobil is definitely in that industry that is tied into oil prices, and it's made a fairly decent run overall. But one of the things that has now happened is we've had some implied volatility. We've generated some implied volatility. So what's one way that you could look at these companies and maybe participate in the movement of these stocks over the near term? What's one thing that we might want to do? Well, if you're willing to buy some of the stocks, if you do want to get long some oil companies, look at maybe selling cash secured puts on them. You can do it via a cash secured put spread, but I'm going to talk just about a cash secured put because I'm getting a little long-winded here today. So just for example, if I look at ExxonMobil and I go out to the May 15th expiration, which is 20 days away here, or 23 days away, and I have ExxonMobil closed at 42.13. 42.13. So if I'm looking at that expiration and I look at the at the money option contract for that expiration, because there's so much uncertainty in the marketplace, we see the implied volatilities all the way up around 70 or 65% for that expiration. That's just kind of crazy numbers that we're looking at. 65% implied volatility on ExxonMobil. So why am I picking that expiration? Well, it's the normal May expiration. Usually get better markets overall. We're very volatile markets. The at the money straddle right now is trading for, we'll call it $6, maybe a little more, maybe a little less based off the wide bid-ask spreads, but we'll call it $6. So we're going to go at least $6 down and look at selling a put on this underlying. So if I go out, so remember, we have 23 days remaining. If I'm trying to find some underlyings that I might trade or to get long some of the energy companies, I could sell puts. Now pick a few of them, sell a few of them, but be prepared to buy the stock because that's kind of what you're looking to do in this scenario. And if I sell the 36 strike put right now, the midpoint of that put, remember the markets are closed, is about $1.10. So I'm saying that if the market goes down, at least the expected move at $36, I'm willing to buy 100 shares of stock. And for saying I'm willing to buy over the next 23 days, I will be paid $1.10 for doing that. I will have a margin requirement. This can be done in retirement accounts if your firm allows you the ability to do it. But you would have to have the cash saying that I would be willing to buy this underlying at $36 or $3,600 for every one option contract that you're selling. That is called a cash secured put. All right. So that's going to be it for this episode of Options Playbook Radio. If you have a topic you'd like to discuss on the show or a question you'd like us to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com. Thanks for listening, and we'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money, and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.